Hi there. Just work out if there's audio on that. Okay, I think there is. Hi there. Thanks for joining me today. My name is James Oram. I'm a consultant here at Greenstone. So this is the first of a four-part webinar series we're putting on before the end of the year, where we hope to inform you of the latest trends in non-financial reporting. So firstly, we're kicking things off today with market-based emissions. So this is not exactly a new trend in non-financial reporting. It was actually published in 2015, but we found there's been some confusion around the methodology, specifically around contractual instruments that can be used to prove your company is purchasing low or zero carbon energy. So just running through the contents. Firstly, we'll give you some background on trends in renewable energy, why those trends have occurred, and the market-based methodology itself, running through definitions. Then a hierarchy of applicable contractual instruments you can use to prove you've purchased from zero or low carbon sources. We'll then work through a worked example and then how Greenstone can help you. So firstly, with the background, I'd like to briefly run through some background on overall trends in renewable energy to give you some context as to why the GHG protocol has been updated to reflect changes in consumer demand. As you can see from the plots on the right, there has been a dramatic increase in the generation of renewable energy in recent years. In 1965, renewable energy was dominated by hydropower, which generated approximately 100 terawatts of electricity. Since then, the amount of hydropower generated has increased dramatically and remains the dominant source of renewable energy. However, it's worth noting this considerable rise of other forms of renewable energy in recent years. Between only 2006 and 2016, the global consumption of solar energy has increased by an impressive 5,400%. Over the same time period, electricity consumption through wind has risen by 620%. Between 2011 and 2017, onshore wind capacity has doubled. So in the last 10 to 15 years, renewable energy is now seen as a commercially viable alternative to traditional fossil fuel-based energy generation. But why is this? Why has there been such a rapid upward trend in renewable energy? Well, there are numerous reasons for this. Firstly, nations have increasingly committed to reducing their overall carbon footprint, whether this be through their own internal targets or internationally ratified treaties such as the 2015 Paris Climate Agreement. This is a global effort which aims to keep warming well below 2 degrees C threshold said to alleviate the most devastating effects of climate change, a target which we have little chance in reaching if the latest IPCC report is anything to go by. Secondly, there's cause for countries to diversify their fuel mix to improve their energy security, whether the concern be due to physical unavailability or extreme spikes in energy prices. As the uptake of renewable energy has increased, the price of generation has fallen rapidly. Fierce competition, reduced manufacturing costs, and increased efficiency in both construction and energy conservation have led to a dramatic fall in the cost of energy generated by renewable sources. And as you can see from the figure on the right, this is particularly prevalent for solar energy, which has reduced from 2009 to $550 for the average cost of a megawatt hour to approximately $50 per hour. Note the dramatic fall in the cost of solar has coincided with a large increase in generation shown in the figure on the previous slide. Because of the reasons that I've just been through, wind and solar have now achieved grid price parity. This is defined as when a source of energy can generate power at a price that is less than or equal to the price of the purchasing power from the grid. As I just mentioned, it now costs $50 to produce 1 megawatt hour of solar power, which when compared to coal, which is $122 per hour, is much, much lower. So, as well as there being an environmental argument for using renewable energy, there is now an economic one, a strong economic one. Moreover, issues around intermittency have now been resolved with improved performance and increased affordability of battery storage. The last point to make here is there is also now government incentives to encourage the installation of renewable energy projects. A good example of this are contracts for difference, where there is a difference between a strike price, which reflects the cost of investing in a particular low carbon technology, and a reference price, a measure for the average market price of electricity. So if the strike price is below the reference price, generators are paid the difference through subsidies. So before we run through the market-based methodology, I think it's worth going through the GHG protocol in general and then the scope shown within the figure. So the GHG protocol is the most widely used methodology for corporations to report emissions. It provides a standard set of rules to source, sort, and account all emissions, both directly and indirectly associated with your business. As shown by the figure on the presentation, these can be divided into three categories. Scope 1 is direct emissions from fuel use in company vehicles and facilities. For example, natural gas in boilers or diesel and petrol in company cars. Scope 2, which will be the focus of the presentation, is a category that covers indirect emissions associated with purchased electricity, heat or steam, as they are generated by your supplier upstream of your operations. As shown here, Scope 3 are other indirect emissions, such as the extraction and production of materials and fuels, transport-related activities in vehicles not owned or controlled by the reporting entity, outsourced activity, and waste disposal. So, focusing on Scope 2, this now makes up a third of all global emissions. The latest update in the GHG protocol, Scope 2 guidance, allows a process for reporting market-based emissions associated with the sources discussed in the previous slide. This update is recognized and aligned with all major reporting frameworks, such as the GRI standards and CDP. But what is market-based emissions? Well, before 2015, any update in the reduction of Scope 2 emissions was only possible through energy efficiency and saving measures. While obviously this is still encouraged, you can now demonstrate emission reductions through your purchasing choices, reflecting trends in renewable energy consumption discussed previously. The traditional way of reporting Scope 2 emissions is using the location-based method, where emission factors are based on average emissions associated with all sources of electricity within a predefined area, whether this be at a national or regional level. For example, a variety of sources such as coal, gas, nuclear, and renewables could all contribute to a country's grid mix. The method outlines that you calculate your emissions by multiplying your consumption by the average emission factor associated with all types of generation within the country or region in which you operate. In contrast, the market-based methodology reflects the emissions associated with a particular generator you choose to purchase your energy from. These purchases are proven through various contractual instruments which will be described in more detail. However, it is important to note that these need to be provided to validate any market-based emission factor used. Also worth noting is that the methodology does not replace the traditional location-based approach. Rather, the emissions associated with both methods should be published together. This is termed dual reporting and allows for comparison between the emissions associated with your purchasing choices and your emissions related to consumption from the grid. So here we just have a slide with the location-based reporting hierarchy I just explained. So the first priority is the regional or sub-national emission factors. When these are unavailable, you revert to national emission factors, which obviously cover a much broader area. And what we have here is the 2015 market-based reporting hierarchy, which you can see is much more extensive. So these are made up of the various contractual instruments which you can use to prove the procurement of zero or low carbon energy. At the top, we have energy attribute certificates, followed by contracts such as power purchase agreements. If you wish to report zero emissions associated with your Scope 2 consumption, you need to provide evidence from these two levels. If these are unavailable, you can use supplier-specific emission factors to reflect the procurement of energy from a green tariff, for example, which has an emission factor lower than the grid average. If no evidence can be provided, the methodology states use a residual factor, which is calculated with all tracked and claimed renewable energy removed, and therefore is higher than the grid average. At the very bottom, you have the location-based factor, which in the absence of a residual mix factor in your area of operation is used instead. So now we'll run through the market-based reporting hierarchy in more detail, just to give you some examples and some descriptions of the instruments that can be provided. So we'll start at the top with energy attribute certificates. One certificate guarantees that 1 megawatt hour of electricity has been procured from 100% renewable sources, with no emissions associated with its production. Certificates are issued through an online tracking system and can only be claimed once. Each certificate is assigned a unique number that tracks ownership, and only through this code can that unit of energy be reported. This system removes the chance of any form of double counting. Renewable energy generators themselves sell energy attribute certificates to suppliers either together with electricity or separate through a market independent of the location's energy market. These energy attribute certificates are used by businesses because they are, in general, unable to source renewable energy directly. So they rely on these certificates to reduce their Scope 2 emissions. By purchasing energy attribute certificates, it enables companies to demonstrate their commitment to climate goals and help them meet their own targets. EACs are favoured by RE100 members, a commitment made by businesses to go 100% renewable. 85 of US-based companies and 60% of companies with operations in the rest of the world are using EACs to meet their renewable energy targets. The hope is that with the incentive of wanting to report lower Scope 2 emissions, companies purchasing renewable energy certificates will in turn send a signal to the market by driving the demand for low-carbon electricity generation. So on the next slide, we have a map of the various types of certificates in the various regions around the globe. They're essentially all the same with the definition just described. It just depends on the region you're in. So we have renewable energy certificates in North America, guarantee of origins in the EU, renewable energy guarantees of origin within the UK, and IREC or tradable instruments for global renewables, which provide a blueprint for tracking energy attribute certificates in emerging markets. In Europe, but due to the common energy market and cross-border infrastructure, guarantees of origin can be openly traded. This is not the case for other certificates, with the hope that keeping certificates in the country of origin, this will push forward the development of renewable energy within that area. So second on the list of priorities, we have power purchase agreements. These are long-term electricity supply contracts, usually between 12 and 20 years, concluded between the electricity consumer, i.e. the company, and the generator of renewable energy directly. These long-term contracts are of benefit to both parties. For the consumer, it provides a fixed power price over a number of years, enabling companies to hedge their business against long-term power price risks. And for the supplier, their revenues are determined over a long period of time, and therefore they can facilitate future renewable energy projects. As such, power purchase agreements are a benefit to both the buyer and the seller. The use of power purchase agreements is expanding rapidly. In 2017, corporations signed a record 5.4 gigawatts of renewable energy power purchase agreements in 10 countries. By the end of July this year, corporations had surpassed this, signing for 7.2 gigawatts in 28 markets. Just to reiterate what I said previously, these are the only two types of evidence that your organization can use to report zero emissions associated with your Scope 2 consumption under the updated GHG methodology. It is with this third priority, supply-specific emission factors, that you can convey the procurement of energy that is lower than the grid average, such as green tariffs. Green tariffs are defined by the GHG protocol as a consumer option offered by an energy supplier that is distinct from the standard offering. As you can see, this is quite a broad definition that could consist of 100% renewables or a mix which includes some fossil fuels. As such, purchasing a green tariff is not enough to report zero emissions. If energy attribute certificates or power purchase agreements are not available, your supplier may still offer a supplier-specific emission factor which is lower than the national or grid average. So in spite of not having a certificate, it's well worth contacting your supplier for one of these factors if available. If any of these are not available, including the supplier-specific factor or any contracts or energy attribute certificates, the priority then moves down to a residual mix factor. This is calculated based on all unclaimed or untracked energy, which is basically removing renewable energy which has been accounted for from the mix. They will generally have emission factors higher than the grid average due to the deduction of certified renewable energy from the fuel mix. If your reporting area doesn't track renewable energy, and this is generally at a national level, and as a result has no residual mix factor, then instead the applicable location-based factors are used based on the hierarchy discussed for the location-based method. So now that we've run through the types of evidence that you can use and the definition of the market-based methodology, we now have a table which shows the dual reporting methods you'd be expected to use. So the table gives examples of different emissions using both location and market-based method. So as you can see from the USA and Mexico, these use renewable energy certificates and power purchase agreements to cover 100% of their consumption. So for the renewable energy certificate, they will have, for every megawatt hour they've used over the year, they will have an equivalent certificate. For Norway, because their energy mix is made up of a high proportion of renewable energy, much of which comes from hydroelectric power, once that's been removed from the grid mix and accounted for by renewable energy certificates, for example, the residual mix that has been left is much, much higher than the location-based, and hence the market-based emissions total is much higher. For China, they don't have any certificates or supply-specific emission factors which they can use, but there also isn't a residual mix factor available, so hence why the location-based total and the market-based total are the same. For the example for India shows that PPAs cover 50% of the consumption, with the rest of the consumption being made up of a residual mix factor. As you can see, the market-based total, with only some of the consumption being accounted for by supply-specific emission factors and certificates, is still much, much lower than the location-based method, making it worth accounting for and publishing. So now on to the Greenstone environment module and how we can help here at Greenstone. So some of you may already be aware that we've recently updated our environment module to allow you to better account for and track your market-based emissions. In the first instance, you can upload your market-based emissions using the updated standard template shown here in the image at the top, or the input form shown on the bottom left. And so instead, if you just want to add the emission factor itself to keep a log within the system, they can be added in the same way and the system will calculate the emissions for you. So to reiterate, you can either put in a market-based emissions total, or you can put in the actual factor and the environment module will calculate the emissions total for you. You can also note the instrument type, which can be any of the following that have been discussed above: an energy attribute certificate, a contract, or a supplier-specific factor, to keep a log within the system. Moreover, you can also attach any supporting evidence you have to verify the factors you have used within the system. If for a site you don't use a market-based factor, the system will follow the market-based hierarchy as discussed, using either a residual mix factor, if available, or the equivalent location-based factor. Another update that we put in the system recently is within the dashboards, where you can now toggle between the market-based and location-based emissions from within change settings, as shown on the bottom right. This gives you a quick and easy way to compare the emissions associated with the two Scope 2 methodologies. There is also a dedicated Scope 2 report you can run through, which will give you a breakdown of your market-based emissions within the period prescribed. This is currently being the process of being revisited. So within the near future, we hope to offer you a future breakdown so you can more easily see the factors being used to calculate emissions for each individual site for a specified time frame. So just to run through the steps that need to be taken to use the new methodology if you're thinking of doing so. First, you run through the current reporting and data collection process. You identify the greenhouse gas emission sources for your Scope 2 emissions. Does the market-based methodology apply in any of those areas? Are you purchasing zero or low carbon energy? Do you have the correct certification to prove this? At Greenstone, we can reach out if needed to all the offices outlining the types of evidence required and the context around them providing it. Upon collection, we can verify the contractual instruments provided. And then as described, using the enterprise system, you can calculate your market-based emissions for your reporting period as the system uses the logic described and will account for things like building apportionment and closed sites. And the last point is to roll up greenhouse gas emission data to a corporate level. And that is basically it for Scope 2 market-based emissions. I hope that has been some help to you and has given you some food for thought if you're looking to doing it, and hopefully provided you enough information of the kind of contractual instruments and evidence you need to provide and the process and method used to calculate your Scope 2 market-based emissions. If you have any questions regarding the presentation or any follow-up, please get in contact with either myself or any of my colleagues here at Greenstone. Thanks. That's it, right? don't know how to do it. I bet that was like 10.